Good morning. Happy Monday. I hope everyone had a great weekend. Well, welcome on behalf of Island Park Private Wealth to our Monday morning market recap. So, today we're going to break down what really happened in the markets over the past month and really talk about why investors are both optimistic and nervous heading into year end. The major headline is that the stock market logged its seventh straight monthly gain. That sounds great, but the story underneath the surface is a lot more complicated. One, the market is flying blind. Because of the 43-day government shutdown, we didn't get the usual flow of economic data. No jobs reports, no CPI numbers, no GDP print. But investors and policymakers have been navigating with partial September data and models instead of government numbers. In the middle of the uncertainty, the market latched on to one idea. The Fed is likely to cut interest rates again in December. By month end, the markets were pricing in an 85% chance of that. And that expectation helps support everything from stocks to bonds to crypto. Point number two, stocks. On paper was a win, but a rotation in reality. The S&P 500 edged up just 0.2% in the month of November, but that tiny gain hides a massive shift. Mega cap tech, especially the AI darlings, finally cooled off, dropping almost 5% as AI fatigue set in. Meanwhile, defensive and value-oriented sectors, healthcare, consumer staples, materials, and energy all outperformed. So even though the index was flat, the market leadership changed. Investors rotated from high growth names into more stable parts of the market. On the international side, developed markets held up and emerging markets slipped. Point three, bonds rallied. But the credit spread sent a warning. As expected, bonds moved higher as traders bet on that December rate cut, and with investment grade debt continuing to outperform thanks to the falling yields. But there was a warning sign. The spread between the risky triple C rated bonds and the safer double B rated bonds is now the widest it's been since August of 2024. And that widening usually signals growing concern about the economy and credit quality. Point number four, the Fed, their messaging whipsawed the market. The Fed added to the volatility. Early in the month, they sounded hawkish. And later in the month, after a cooler inflation print and rising unemployment, they shifted back to a dovish stance. The bottom line, the Fed policy is not settled. And the market may be overconfident about how quickly rate cuts will come. Point five, earnings are the bright spot and continue to be the bright spot. Corporate earnings continue to impress. 83% of S&P 500 companies beat earnings expectations. Earnings grew over 13%. And revenue growth hit its strongest level in more than a year. Now, valuations, especially for those AI stocks, are high. So that means that any setback hits harder because the optimism is already priced in. Point number six, the economic picture is slowing but continues to grow. Now that the shutdown is over, early data suggests the following. Hiring is slowing. Unemployment is rising. Consumer sentiment is near pandemic lows. And manufacturing is still in contraction. Despite all that, the economy continues to expand, just at a slower pace. So until the data backlog clears, we really won't get a clean picture of where things really stand. So point seven, where do the markets go from here? Here's the simplest way to look at it or think about it. We are in a late cycle expansion. Growth is narrowing. AI investment and expected rate cuts are continuing to support the markets. But under the surface, the traditional economy, labor, housing, manufacturing, looks fragile. So the bullish case for the market, that we're going to continue seeing earnings strength, that the AI investment cycle continues to grow and expand, that the Fed delivers on those rate cut expectations. And on the flip side, the reverse or the bearish case centers on the following: high valuations, slower growth, unresolved geopolitical issues, and rising credit spreads. So, where does Island Park Private Wealth stand on this? Our view is pretty simple. We are still we still believe it's a constructive environment for risk assets, but it's not a market you want to chase. Selectivity matters more than ever, and continued diligence or discipline in investing always pays off. So we want to thank you for watching. We hope you found this breakdown helpful. And if you did, hit the subscribe button and let me know if you want a deeper dive in any part of this month's status. So we'll see you next Monday, and have a great week. Thank you.